Hey guys, welcome back to my channel. Today we're going to look at the top 10 mistakes that beginners make when they start investing in the stock market. When you start investing in the stock market, you have little knowledge and you can easily get carried away, which leads you to make the wrong decisions and which ultimately will cost you money. So if you want to maximize your gains and minimize your losses, you have to have the right mindset and avoid common mistakes. In this video, I will show you the 10 mistakes that are most commonly made by beginners and how to avoid them. The first mistake a lot of beginners make is to start investing before they're ready. And when I mean ready, I mean not only financially ready, but also psychologically ready. To be ready financially, there's two criteria that come to mind. First of all, you need to get rid of all your high interest debt. So especially in the United States, where the credit card industry and the payday loan industry is huge, a lot of people have debts with interest rates that can be of 18, 20, 25%. So as long as you have interest rates that are this high, there is no sense in investing your money in the stock market, while returns will generally be much lower. So the average return of the S&P 500 is about 8 to 10% yearly, and as you can see, that's way under the 20% bar, which is quite common for some credit card or payday loan or other kind of loan shark agencies that are giving you this quick money. So the first thing you need to do is get rid of your high interest debt, and once you've got rid of that, you can allocate that same money you were using to pay your debts to invest in the stock market. So the second criteria to be ready financially is to have an emergency fund. So an emergency fund is money that you've tucked away in a readily accessible savings account where you will have 6 to 12 months living expenses put away for emergency situations. An emergency situation could be a car breakdown, a serious illness, or a job loss, in which case you will need to withdraw money from this emergency account to live and to pay these unexpected bills, rather than cashing out your investments, which will jeopardize your long-term financial objectives. So the two criteria before you start investing: get rid of your high interest debt and make sure you have an emergency fund. Now, when I mean to get ready psychologically, this is equally as important as financial preparation. Psychologically ready means, are you ready to delay your immediate gratification in order to have delayed gratification that can potentially be higher? So this means somewhat decreasing your current lifestyle, or at least sacrificing immediate pleasure in order to have more pleasure down the road. And this is a problem that a lot of people have in the hyper-consumer society. They want to spend as much money as they can. They want to consume and have things. However, just realize that spending your money now sacrifices potentially having more money down the line. So just ask yourself this question: are you ready to delay your gratification to potentially have more later? If the answer is yes, then you're psychologically ready to start investing, because investing takes patience, discipline, and self-control to honor the objectives that you have fixed yourself, and especially honor the schedule of injecting money regularly, be it on a monthly or quarterly or yearly basis, into the stock market to make sure that the objectives you have fixed will be reached. The first mistake a lot of beginners make is to not be ready financially and not be ready psychologically. The second mistake a lot of beginners make is they have unrealistic expectations of what stock market investing can be. So a lot of people, they go into the stock market and they think that they will be able to generate very high gains very quickly. Unfortunately, this is rarely, if ever, the case. Yes, sometimes you may invest in a particular product that generates great returns, but most of the time, on average, over a very long term, your returns will be somewhere in between 8 and 15% yearly. So never invest money that you will need in the next 5 years, because the market can go down and it can stay down for a while, and it might need some years to recover those losses and go back up. So technically, you do not want to be in a situation where you have to cash out your investment that has gone down in value because you need to pay something in your life, like a bill or something like that. So you want to make sure you have your emergency fund and you're investing money that you will not need for the next 5 years. So like I said, the average annual return of the market is around, let's say, 10%. So it's unreasonable to expect anything that goes way beyond that over a very long term. You should not be expecting 30, 50, 100% yearly returns every year for the next 30 years. Yes, some years the markets will go up 25%, but some years it could go down 20, 25, or 30%. So you have to be ready for this volatility and just understand that over the very long term, the market will have a reasonable return of about 8 to 10% yearly. The third mistake a lot of beginners make when they start investing is to trust the wrong people. When you start investing, you don't really know what you're doing, so you're going to be listening to financial analysts, people on forums, and influencers on YouTube and Instagram or Facebook or wherever they may be. So this is a very delicate thing to do, and you want to make sure you don't just blindly trust anyone. First of all, you don't really know what the intention of these people are. Are they out to make money for themselves or to make money for you? Secondly, you don't really know their track record either. Have they actually consistently made money over the years? You don't know that. They don't reveal that generally. And thirdly, even the best analysts can give out a wrong stock recommendation and make you lose money. So what you really want to do is do your own research, and then you can actually listen to an analyst or anyone else to see if it concurs with your own conclusion. But never just take what they're saying at face value and throw your money at whatever stock or random analyst or random influencer is pumping at that time. You want to make sure that you do your own due diligence. The last thing I want to say about this is beware the fake gurus on the internet who are promising you to reach financial independence if you implement their trading strategy or their investment strategy. Generally, these people are simply enticing you, leading you in with bait of future financial success to generally sell you some kind of training program or some kind of workshop that they have, some video sessions, and generally they will be selling these for thousands of dollars, and that is actually how they're making money. They're not making money by trading stocks or investing in the stock market. They're making money by selling you training programs. So you want to make sure that you avoid these people at all costs. If you do want some education, get it from a trusted online source or an actual physical source. Get it from someone who's actually trusted, who has a track record in the investment sphere and who knows what he's talking about, not some random internet influencer who's simply looking to make as much money as he can, as quickly as he can. So beware the fake gurus online and don't pay for these $1,000 courses. They are simply not worth it. If something online appears too good to be true, generally it is. The fourth mistake a lot of beginners make is that they buy products that they don't really understand. For example, you know that Amazon is the leading e-commerce platform and that they sell technology gadgets like Alexa and other developing drone delivery services. Did you know that e-commerce actually doesn't make Amazon that much money proportional to the revenues it brings in? That's right. Actually, where does Amazon make the most money? They are a leader in cloud computing. They own about 30% of the entire cloud computing market share on a global scale. And also, they are a leading digital advertising business. And if you look at the net income generated by these two sectors of Amazon's business, proportionally to the revenues they bring in, they make the most money for Amazon. And they are also the fastest growing segments of Amazon's businesses, which means that in 5-10 years, it could be that Amazon Cloud Services is making the majority of Amazon's net profits. Also, Amazon Sciences is the leader in scientific research, and they have thousands of patents in their portfolio, which means that as time goes by, Amazon will be developing new technologies that will be creating it further revenue streams. And a lot of people don't really know about these business segments. It just goes to show that when you're investing in a company, you need to make sure you know how it makes its money, how it makes its profits, what business segments does it have, and how much profit each segment represents compared to the other. You have to analyze the financial health of a company. How much debt does it have? What are its cash flows? How are its revenues growing every year? Then you can analyze the management. Who is leading the company? Who are its competitors? What are the competitive advantages of this company relative to its competitors? Who are the emerging actors that could potentially disrupt this company's dominance? These are all questions you have to ask yourself when you're analyzing a company to make sure you know exactly what you're buying. So the second aspect of this area is that a lot of beginners don't really understand all the products they're buying. For example, most people know what stocks are, what bonds are, and what index funds are. But a lot of beginners don't really know what options or futures contracts are. So why would you buy these products if you don't really know how they function, the risk that's involved, and how much money you could potentially lose by investing in these products? Which is why as a beginner you want to start small, educate yourself, and once you know more, then you can start buying sophisticated products. But when you're first starting out, stay simple. Do not start throwing your money at things you don't understand. Buy simple products, and then you can kind of branch out as you know more and as you get educated. The fifth mistake a lot of beginners make is that they do too much trading. So trading is when you buy and sell financial products in a very short time frame to take advantage of price fluctuations. Well, the problem with a lot of beginners is that when they start out in the market, they see companies they like, so they're buying that stock. Then a few weeks later, they notice the price hasn't moved much, so they're going to sell that stock and buy other stock that interests them. And they're just going to keep doing this, trying to find that stock that's going to have huge returns in a short amount of time. Well, this is a very bad strategy for 4 reasons. First reason why this is a terrible strategy is that generally you're paying commission fees on every time you buy and sell a product, which means if you're doing a lot of buying and selling, you're paying a lot in commission, and this will reduce your overall profitability. The second reason is that also every time you're selling a stock, if you're making money on that stock, you have to pay capital gains on that stock. So if you're paying capital gains every time you sell a stock and you're selling stocks multiple times a day, you're going to have a lot of capital gains to pay. And a lot of people don't pay attention to this fact. And then, they realize they have to pay capital gain when the tax man comes around, and sometimes they don't even have the liquidity to pay it. So make sure that you only sell a stock when absolutely necessary. You're not selling it on a whim, because it can have big consequences in terms of both commissions and tax implications. So the third reason you don't want to be buying and selling all the time is because your investment needs time to grow. Like I said, it's very rare that a stock will rise in value tenfold in a 1 week period. That almost never happens. So it can happen if you're extremely lucky, but most of the time, investment needs time to grow. So if you're selling a stock today, it could be that in 3 years you look back and regret selling that stock because maybe it did multiply 5 times over a 3-year period, and it's not going to multiply 5 times over a 3-day period. So stocks need time to grow, because remember, when you're buying a stock, you're buying a stock of an actual company who's conducting actual business, generating actual revenues and actual profits. And these companies need time to develop their business and to scale and to generate more profits. And that is when, over time, more investors come in and buy the stock, which drives the price up. But in a very short time frame, it's all based on speculation. And unless you're a professional trader who knows what he's doing, chances are you're not going to be making very much money. And which brings me to the last reason why this is a bad strategy to buy and sell all the time, is because the majority of traders don't make money. So over a very long time period, very few traders are regularly profitable. So there are studies debating the exact percentage of traders who make money, those who don't. But the sad truth is, over a very long term, let's say a 5, 10, 15-year period, less than 20% of traders actually make money. And if you really get down to the nitty-gritty, some studies even say that only 1% of traders are predictably profitable over the very long term. So chances are you are not in that category unless you're an elite trader, unless you have very good instincts, self-control, capital management, risk management, you have solid strategies that you respect, that you never deviate from. These are the people that are going to be making money over the long term, people who actually dedicate most of their life to trading. But for the average retail investor, trading is a disaster, and it's something you should avoid at all costs. Again, keep in mind, do you understand the difference between investing and trading? These are two different approaches, and it's a very bad idea to mix them both if you don't know what you're doing, because it will lead to subpar results. And for the average investor, it's better to just invest long term, buy and hold high quality products for a very long time, rather than trying and buying and selling and timing the market, which is a very bad idea for the average retail investor. Sixth mistake a lot of beginners make is buying penny stocks. A penny stock is a stock that is trading for less than $5, and a lot of penny stocks trade for even less than that, most often less than $1. So a lot of beginners see these cheap penny stocks and they say, oh, well, I can buy several hundred or several thousand of this stock, and if it simply moves by a couple dollars, I've made a ton of money. Well, actually, penny stocks rarely work that way, and it's a very bad idea for beginners to buy penny stocks. The reason being that penny stocks are cheap because they are the stock of companies that are unproven, that generally lose money, and sometimes have some shady management. You don't really know why they're listed and what they're doing and what their intentions are. Also, a lot of penny stocks are promoted by scammers to take your money. So a lot of scammers, what they will do is they will buy a large quantity of these penny stocks. They will start hyping it around the internet through forums, maybe on YouTube or social media, in an attempt to draw in buyers to drive up the price. And then once the price has reached a certain level, they will dump all of their shares, causing the price to crash, and you will lose all of your money, and you will be held on to a stock that is completely worthless and has no future perspective of growth. But that is what we call a pump and dump. People who are pumping the stock to go up, and then once it reaches a certain price, they dump the stock and it goes down, and then you're stuck with worthless stock that you have to sell at a big loss. So avoid buying penny stocks. I know this is counterintuitive, but actually a stock that costs $150 or even $300 is generally a better bargain than a stock that costs 50 cents. A stock that costs 50 cents has more chance of going down to 20 cents than a $300 stock, who actually has more chance of tripling in the next few years than the penny stock does. Why is that? Well, simply because that $300 stock is the stock of a company who, generally speaking, is a high quality company who is a leader in its field and who is growing, generating real profits, and actually solving a real world problem, a product or service that is actually popular and being used around the world. Therefore, this company will actually grow its earnings, attract more investors for the long term, and the price will increase. Whereas that penny stock, it's a company that has irregular earnings. Sometimes they lose a lot of money. They have maybe a product that is not very popular. Maybe they can even lose market share or go bankrupt. And so all this will cause the investors to sell the stock and the stock price to go down. Do not buy penny stocks unless you really know what you're doing, unless you're specialized in penny stock trading. which very few people are. So a beginner mistake is to buy penny stocks, and you want to make sure you stay away from penny stocks altogether. The seventh most common mistake made by a lot of beginners is putting all their eggs in one basket and not diversifying properly. So a lot of people, they'll see a couple stocks that they like, and they will put all of their money into, let's say, 3 or 4 stocks. Well, the problem is, if a couple of those stocks have bad performances, your entire portfolio will be ravaged, and you will not have any room to maneuver to kind of rebalance everything, because most of your capital will be gone. So that's why it's a better idea for a lot of investors to kind of, if you're investing in individual stocks, to have 10 to 20 stocks in your portfolio. So if one stock does badly, it's not going to ruin your whole portfolio, and maybe it's a small loss that you can sell to reallocate those funds elsewhere, and you're taking a hit, but it's not too big. So that's why you want to have, if you are doing individual stock investment, to kind of have 10 to 20 different stocks in your portfolio that you can actively manage, and it will not impact overall profitability too much if some of these stocks go down. So this brings me to the second point, which is not diversifying properly. So this can be not diversifying on a sector basis, and not diversifying across asset classes. So first of all, not diversifying in the sectors. If you are over-invested in one particular sector, such as, let's say, oil, and that sector enters a secular decline or has a temporary crisis, well then your portfolio will be ravaged. And if you're not properly diversified across asset classes, then you are overexposed to one asset class. What do we mean by asset classes? For example, you have stocks, but you also have bonds, you can have cryptocurrencies, you can have real estate. You want to make sure that for a total portfolio, you have investments in each category, which means that if one sector is underperforming, maybe the others are not, which allows you to kind of keep your profitability at a reasonable level. So what are different asset classes? I mentioned some. So you can have stocks, you can have bonds, you can have real estate, you can have precious metals, you can have commodities. If you know art, you can even own art, you can own Rolexes. These are all products that actually could appreciate in value over time, or at least hold their value over time, which will help you protect your wealth or even grow your wealth. So you want to make sure that you are invested across multiple asset classes as much as possible. The eighth big mistake made by a lot of beginners is not buying index funds. So an index fund is a basket of stock or currencies, or a basket of financial products that seeks to reproduce the performance of a benchmark index. So when it comes to stocks, the benchmark index is often the S&P 500 or a particular sector of the economy. So some very famous index funds, for example, the S&P 500 index fund. So this index fund tracks the performance of the 500 largest companies listed on the American stock exchanges. So in one financial product, you are exposed to the growth of the 500 largest companies listed in America, such as Coca-Cola, Walmart, Home Depot, McDonald's, Apple, Microsoft, Google, all these companies that are large, mature, established industry leaders who are growing over time. If you want to invest in a specific sector that you know has more growth potentially, you can, for example, invest in the NASDAQ 100, which is an ETF composed of the 100 largest non-financial companies listed on the NASDAQ stock exchange. Finally, if you want to be exposed to the growth of the world economy, you could buy the Vanguard Total World ETF, which basically tracks the performance of all the largest stock exchanges in the world. So by buying this ETF, you have great diversification with very low management fees, and ultimately over the very long term, very low risk, which led Warren Buffett to say that for the average retail investor, a low-cost index fund is the best investment he can make. So as a beginner, you want to make sure that you do not ignore the value of ETFs, and you should actually invest most of your money in ETFs. The ninth error that a lot of beginners commit is to invest according to their emotions. So a lot of people get euphoric when the stock market goes high. They see high-flying stocks, they have the fear of missing out, so they want to jump on to secure gains. So a lot of investors will get carried away by euphoria and by wanting to make a quick buck when the markets go up, so they will jump on high-flying stocks or buy whatever stock is being recommended by an analyst, and they will not be thinking rationally. And this often leads to catastrophic results because you're buying products you don't necessarily understand, and if the trend reverses and goes against you, you're losing a lot of money. You want to make sure that you do not buy stocks based on emotion. You want to do it rationally. And again, when the market starts to decline, a lot of people will panic sell their positions because they fear losing all of their capital. Never forget that market volatility is inherent to the stock market, and it will never go away. And over the very long term, markets tend to go up. Therefore, if you are holding on to high-quality financial products, you should not sell because the price is going down. If the price of an asset is going down, ask yourself these questions. Is it due to a temporary crisis that will be resolved soon, or is it due to a structural, fundamental decline of either the asset class fundamentals, or is it because the world economy is crashing and will never recover? Once you ask yourself these questions and you try to answer rationally, you will have the answer as to why you should sell. If the world economy is going to crash and end tomorrow and it's going to be total chaos, then yes, maybe you should sell your investments. If the company also is going in structural decline and could go bankrupt next week, you should probably sell that investment. But if it's simply a temporary blip in the road, for example, one quarter where profits were slightly inferior to what analysts expected, that is not the end of the world. And maybe next quarter the company will beat the revenue predictions and you will be a happy camper having held on to that stock. So make sure you ask yourself, is it a temporary blip in the road, or is it actually a fundamental crisis of the asset or the company in question? And always try to stay rational and take emotion out of the investment process. So the last beginner mistake that a lot of beginners make and that you try to avoid is they don't try to learn. They don't try to further the knowledge. You should always be a student of the stock market, and you should try to get as much knowledge as you can. The more you know, the less mistakes you will make, and the more you will maximize your gains and minimize your losses. This means reading a lot. Reading about great investors. How did they invest and make their money? You should learn about business. How does a business operate? What makes a great business? What makes businesses fail? You should also learn about management. What makes a great manager? Because businesses are led by managers, and you want to make sure that you're investing in businesses with solid managers who are innovative, forward-looking, and revolutionary. Lastly, you should read about industries you're interested in. If you're interested in tech, read about the tech industry. Who are the leaders? What are the innovations that we should expect in the coming years? Who are the emerging actors who could disrupt the leaders? And this will help you maybe identify up-and-coming companies that could have bright futures. In what direction is the world economy headed? You have to also analyze the world economy. What drives the world economy? What are the big factors that cause recessions or that cause expansions? What are political decisions that could swing the economy one way or the other? In what direction is headed the economy? Are any emerging markets interesting to invest in? Which are the economies of the future? Which are the economies in decline? These are all things that you have to look into and analyze in order to help you make better investing decisions. Finish on this point, I will cite Charlie Munger, who is Warren Buffett's longtime and historic investment partner, one of the legendary investors of our time, who said this, and I'm paraphrasing. Over my lifetime, I've never met a wise person on a variety of subjects who didn't read a lot. Never. Not a single one. You would be surprised by how much Warren reads, and myself as well. My kids make fun of me, saying I'm basically a book with two legs. And in fact, I've seen interviews of Warren Buffett and his team, and they all say that they spend 10 to 12 hours a day reading. So basically, reading is one of the most powerful tools you have. And these days, thanks to the internet, knowledge has never been so widespread, and you can learn about anything you want at any time you want. So make sure you use that tool to empower yourself to become a better investor. So those were the 10 most common mistakes beginners make when they start investing in stocks. I hope this video helped you and that you will work on yourself to make sure that you adopt the right mentality and that you avoid these beginner mistakes which will make you lose money. So thanks again for watching this video. Leave a thumbs up to help me beat the YouTube algorithm, subscribe to my channel to be notified of future publications, and don't hesitate to leave a comment below to let me know what you think of this video. Thanks again for watching, guys, and I'll see you next time.